Welcome to everybody. My name is Paolo Surico, and together with my colleague Andrea Galeotti, we have put together a series of mini lectures as a user guide to COVID-19. Today, I'm going to cover part 3 on economics for dummies. What we are trying to do in this mini lecture, what we want to do is to present evidence on the initial cost of the crisis. We want to illustrate the working of the economy using a very simple aggregate demand and aggregate supply framework. We want to present evidence on the dependency of firm investment and household spending on cash flow. What are you going to learn at the end of this talk? Well, you should be able to use initial evidence to guess the size of the total economic cost. Understand the role of uncertainty and panic in shaping economic cost dynamically, and understand the central role of cash flows, shortages, in spiraling the health crisis into an economic crisis. Let me start to give you a sense of the magnitude of this crisis. This chart gives you a forecast in real time of what output growth might be in the second quarter of 2020 for China and for the euro area. This is daily because every day gathering information on Google, on the large data with machine learning, data release for major manufacturing series, every single day, there is an algorithm produced by Nowcasting that can forecast those numbers in every day. Until the end of February, the forecast for GDP in China was above 6%, very similar to the number that we have seen in the last few quarters for China. But as the first hard numbers start to come out, and as soon as the dimension of the crisis starting to become apparent, as a matter of few days, the forecast for Q2 2020 in China dropped from above 6 to below 3%, a change of 9% of GDP. And at the present day, it looked like there will be a mild recession in China in the second quarter of 2020. This is very significant because this is a country that only a few weeks ago was expected to grow above 6% and now is -1, a gap of 7%. The euro area is not a much better situation. The drop is smaller, but simply because on average growth is smaller. At the beginning of January until the end of February, the forecast was for an anemic growth rate between 0.2 and 0.4. But as the news and the spread in Italy and then in the rest of Europe start to become apparent, the latest forecast predict a recession already, a negative growth, already in the second quarter of 2012 or 2020, as large as -0.3. A change of more than half a percentage of GDP as a matter of few weeks in the forecast for the second quarter of 2020. What are those forecasts based on? Well, some evidence already comes from the stock market. This is the price of shares. This is the value of firms. Those are typically forward-looking variables that tend to predict and price in where the economy is growing. No matter which part of the world you look at, the drop in the value of stock market goes from 10 to 40%. Those drop has been large, and it's very likely there are going to be many more to come. Which large drop followed by some rebounds. Some people realize that they can make some gain from the short drop, but then there is another long drop and a short rebound and another larger drop in a way that overall can make a very significant change to the stock market. How about the real economy? There is surely a direct effect coming in a combination of panic, uncertainty, and the lockdown policy. The first two sectors to suffer from this are the traveling industry and restaurant. What we see here is the sharp contraction in the number of people traveling. -80% in the Asia Pacific, -30% in Europe. And those are lower bound. Surely the number can only become larger. The drop can become only larger the more countries get locked down. This implies a lot of pressure on airline companies that have already started to default. Unfortunately, a very similar picture emerged also for restaurants. as a matter of a few weeks, between the 9th of March and the 16th of March, on sources, internet sources like OpenTable, we have seen a drop in reservation as large as 80% in the UK, in the US, and worldwide. A similar picture emerged in what economists call hard data. This is a number of percentage change in car vehicle. Why do I focus on this number? Because in my previous research on the US, on Italy, and in the UK, I have always found that when people are in difficulty, they receive a negative income shock or there is uncertainty, the easiest way that they found to cope with this is to postpone large durable purchases, like for example, a car vehicle. This is something that is very easy to postpone. I wanted to buy a new car. I can wait a little bit more because now I don't have cash, because I'm not sure whether I can keep the job. I'm not sure what's going to happen in the future. What I found in my previous research, that when you see large swing in vehicle purchases, a large recession is going to come. Look at the data for China now. The number were oscillating between positive and negative. There were a few more negative, but then in the first 2 weeks of February, China experienced a drop of 92% in vehicle purchases. This is not just the effect of lockdown, which was only on the part of the country. This comes from the precautionary saving, the panic and the uncertainty in the entire nation, bringing a drop as large as 92%. Another important factor to consider is that the longer the lockdown will imply that many professions and many sectors will be encouraged, if not forced, to work from home. But working from home is not for everybody, is not for every sector. So you want to gather a sense of how costly could be for an economy if people start switch to working from home. A simple way of understanding this could look at this chart. This comes from the US, from the Bureau of Labor Statistics, and what you see as the grid triangle is the number of workers in each of these sectors. All these workers together account for 100% of US GDP. What you see as a blue dot is an estimate of the number of workers in each sector that can potentially be working from home. A number of points I would like you to take away from here. First, no blue dot tends to be very close to the green triangle. In fact, they are not even halfway. They tend to be much closer to the zero line than they are to the green triangle. This means that less of the labor force in each sector can actually work from home. Of course, we can expand capacity, and in the few months, if not weeks, we have seen a large switch and many more people working from home. But those gaps are very large. In education and health services, we are seeing 35% of the population of workers, 35 million of workers, but only 10 million that can potentially work from home. But surely we have expanded these lately. Also, I want you to take away that there is a large heterogeneity across this sector, with some sectors that are much more prone of working from home than other sectors, leisure or hospitality, construction services, cleaners, restaurant, cinema, theater. Those are all sectors, those are all part of the economy that simply cannot work from home. You shut down the country, you just lose all the value added. If you sum up all the blue dots, the number of workers, you don't get even closer to 50% of the entire labor force, which again suggests that the lockdown is going to impact heterogeneously across sectors, but also very largely overall the entire economy. What implication is this for supply and demand? So here I put my hat of the economist on, and I describe a very simple framework of aggregate demand and aggregate supply, and price and quantity. Demand is downward sloping, lower price tend to accommodate higher demand, and higher price tend to discourage demand, whereas as far as supply is concerned, prices are higher, firms want to produce more, and the other way around where prices are lower. At first, you can think of COVID-19 as a supply shock. People in China cannot go to work, firms cannot produce that intermediate input, which are so much used, for example, in car or for example in electronic, in other large parts of the world. This is a disruption of the global supply chain. This implies that for the same quantity, the aggregate supply shifts up in a way that contracts quantity and increase prices. Less output is produced, and that output that is produced, now you have to pay more because there is more competition to get that piece. Is this the end of the story? Well, not really. Why? Because now that there has been this global supply shock, which is the direct effect, there are a number of indirect effects that comes in. There is uncertainty about how long this is going to be protracted. There is uncertainty whether each of us has got the disease. You want to save more money. You don't want to make an investment because we don't know when isolation will be finished. We don't know whether we are going to lose the job because of the drop in the economy. We don't know whether we are going to be infected or we are maybe already infected and therefore will not be able to work anymore or we will lose our job. So what's happened is that you contract demand. You start spending a little bit less in anticipation that you may need this money a little bit more later. Aggregate demand contracts more than aggregate supply in a way that implies a further decline of quantity, but now also a decline in prices. But of course, if there is uncertainty on the household side, there is uncertainty on the firm side. They see that there are large disruptions, and they see that households are decreasing the demand for the firm's product. So this is not a good time to invest. But if firms don't invest, this further contracts aggregate demand. But what does it mean that aggregate demand contracts? What does it mean that people start to consume less? This means that people are starting to buy less. And if they buy less, it means that sales of firm drop. But if sales of firm drop, this means that firms do not have any more cash flows. As we are going to see in a few slides, for many firms, especially small and young, cash flow is a very important component of their business model. Without cash flows, they simply cannot operate, and therefore they need to bankrupt. They need to close. And this is where demand and supply keep racing each other without ever meeting. Why? Because a firm closure means that many workers will get laid off. But if many workers get laid off, they lose their job, they lose their own cash flow, they lose their income, and therefore they cannot consume anymore. But if they cannot consume anymore, demand will go down, pushing the recession into a greater and greater recession and eventually in a depression. But this large drop in demand generates even further uncertainty and put even further pressure on the cash flows to firm, which they don't see anymore because sales contract, because consumption is contracted. But if cash flows to firm contracted, some of firms will bankrupt, which implies they are going to lay off more workers, we will generate a further decrease in consumption and a further drop in demand, and so on, so forth. Let me give you a little bit of evidence of the importance of the cash flows, because what I think we're going to see is a short circuit of cash flows. In this chart, I'm drawing from evidence that I have put together with colleagues at the Bank of England in my own research on the universe of private firms. Private firms are firms which are not listed on the stock market. This could be your convenience shop down the road. This could be whatever other small construction company, small service company, which are not listed on the stock market. What you see on the vertical axis is the cash flow to asset ratio. A firm which is reliant mostly on their cash flow would have a ratio which is quite big. Why? Because the asset is very small, it doesn't have much asset. Most of what they gain, it doesn't come from the income that they get from the asset, but it's from the income that they get from the sales, which is a measure of cash flows. What you see on the horizontal axis is a measure of the size of the firm, where the size is measured by the value of the asset of the firm. Small firms have below 100K or 250,000 Ks of pound as value of their asset. What we see is that this curve is very sharply steep. Small firms tend to have a much larger cash flow to asset ratio. In other words, small firms tend to be much more dependent on cash flows to run their business. They don't have much asset, that's why their cash flow to asset ratio is so high. If they don't get cash flow by selling to consumer, because consumer they don't want to buy anymore for precautionary motive or for panic or for uncertainty, they can not run their business anymore. They cannot pay their suppliers anymore. They cannot pay their worker anymore. To give you a sense how important this effect could be, I have drawn here as horizontal axis 0.5. This is a cash flow to asset ratio such that your cash flow is equal to 50% of the value of the asset. This is an arbitrary but used measure to give you a sense of the dependence on the cash of a firm on its cash flow. Firms which are above this threshold are firms which are more dependent on cash flow to run their business. Just to give you a sense, in the UK, firms with cash flow to asset ratio above 0.5 account for about 10% of employment share among private businesses. Because private business account for around 50% of total employment in the economy, with the remaining 50% accounted by publicly listed firms, this is telling us that firms which are more reliant on cash flow, those firms which are more likely to suffer from the drop in demand generated by the panic and the uncertainty of the coronavirus crisis, might account for a drop of 5% in employment, an extremely significant number. Unfortunately, the problem of cash flows is not just for firms. As I have documented in other research on households, also households face significant liquidity shortage. What you see on the right chart is the share of renters, homeowner with a mortgage, and homeowner without a mortgage in the UK. 40% of the population have a mortgage, and 30% are renters. If you look at the balance sheet, if you look at their portfolio, if you look at their wealth, and you split this into liquid wealth and illiquid wealth, for example, housing, you find that there is a stark contrast between these three different groups. For example, consider outright owners. They have a lot of housing wealth because they have a house and they don't have any mortgage on the house. At the same time, they also have a lot of liquid wealth. What is liquid wealth? Are savings, cash, stocks. And if you look at the interquartile range, so people at the left and people at the right of the distribution, still they have liquidity. They look like unconstrained. They look like they have sufficient liquidity to be responding to a negative income shock. At the other end of the spectrum, you find renters. By definition, they don't have housing. And as you could imagine, they tend to have very little liquid wealth. Here, 0 refers to the median value. What is the median value? Is the point of distribution that leaves 50% of the population on one side of the distribution and 50% of the population on the other side. Not only, but if you look at the interquartile range, you see that there are many people in negative territory. What does it mean? It means that they have unsecured debt, whereas there are a few of them that have some little liquidity. So clearly renters are constrained. Renters have very little cash flow, have very little money that they've put aside in the face of an adversity. If they lose their job, they cannot pay their rent. If they lose their job, they cannot consume anymore. But this is not just about renters. There is also a significant share of the population which is also facing liquidity shortage. And this is a little bit more surprising. Why? Because they are wealthy people. Those are households with a mortgage. They have wealth, housing wealth. However, most of their wealth is illiquid. What does it mean? They cannot move it easily around. They have a significant share of housing wealth. Why? Because they have a house, but they also have a debt on the house. They are repaying the mortgage. That's why it's smaller than for outright owners. However, they have stretched themselves a lot to pay down a deposit to be able to buy the house. So in fact, when you look at their liquidity, when you look at their saving, when you look at their stock participation, actually their median value is zero. I was very surprised in finding in my own research that about 50% of households with a mortgage live with a level of liquidity that is below half of their monthly income. Those are people that if they leave the job, if they lose their job, they cannot pay their mortgage anymore. Those are people that if they lose their job, they cannot consume. Those are people that if they lose their job, they will be forced to sell their house. But of course, if everybody sells the house, then house price will go down in a financial crisis of the type that we have seen in 2007 and 2009 with the Great Recession. So the bottom line is that there is a significant share of the population that might be hand to mouth, that might live and consume most of what they earn. This is 50% of mortgagors, which on their own would represent 20%, the 50% or 40% of the population. And there is another 20% of renters, which are very likely 20% of the entire population. And there is another 20% that is very likely to be cash on hand. Put the two together, you might have something as large as 40% of the population that rely on cash flows to pay their rent and their mortgage and to support their consumption. If they lose their job, all this demand will sharply drop. So what have we learned in this lecture? A global recession seems to be inevitable. Possibly it will occur in emerging markets too. Overall, despite this is a supply shock, which beginning with, the demand effects are probably going to be much larger than the initial supply shock. Uncertainty, panics, and lockdown policy seems key to be driving the large drop in demand. Also, very importantly key, the investment of many firms, especially small and young, and the spending of many households. We have identified around 40%, especially among renters and mortgagors, depend largely on cash flows. If the large drop in demand forces firms to close, and therefore to lay off those people, they won't have the income to pay for their consumption. And the economy enters a depressing loop that will be very damaging. This is very much for part 3. In the next part, we're going to see what are the policy options in the face of this very large economic depression. Thank you.